Hey guys, as index funds and ETFs continue to grow in popularity thanks to passive investing as a strategy, one of the most common questions I get asked is, Ken, what index fund or ETF should I invest my money into? There are always going to be index funds and ETFs being created all the time as the quality of such funds increase over time. What I think is a far more powerful question to ask is, what should I be looking for before I actually invest into an index fund or an ETF? So today I'm going to walk you through 8 things that you should be checking before you invest your money, your hard-earned money, into an index fund and ETF. Think of this video today as a bit of a checklist. I'm literally going to walk you through 8 things that I usually check before I invest. And if you tick off these 8 things, then you'll be on your way towards making sure that you've done the necessary checks before putting your money into such an investment. You typically do the same checks if you were buying something really important to you, like buying a house, for example. So why don't we make the time to do these necessary checks before we invest our hard-earned money? I hope this video today will make this process super easy for you, because these 8 things I'm going to share with you today should really help you going forward be able to really assess what index funds and ETFs are best suited for you, and to make sure that you've ticked off what's necessary to invest in the right ones. As you're watching this video today, I'd love for you to please make sure you hit that subscribe button, because that just helps us to continue to grow this channel and have so much more impact. If you really enjoyed this video, come on, hit the like button, because that just helps this video continue to be promoted to so many more people. One more thing to ask you, do please take a screenshot of this particular video you're watching and head over to Instagram and post a story and tag us at The Humble Penny. My name's Ken of The Humble Penny and Financial Joy Academy. What we do on this channel is to give you guys the tips, the insights, the practical hacks to help you work towards a dream life of financial independence and money joy. Let's dive in now and look at these 8 things you should be checking before you invest into an index fund or an ETF. I'm going to head over to my board over there and just illustrate these various things to you. Okay, so the first thing you want to be looking for in terms of a checklist is you want to look at the fund size and age of that particular index fund or ETF. In terms of fund size, you want something that's at least £100 million plus in terms of size. So I typically aim for at least £1 billion is what I typically aim for, but you definitely want it to be more than £100 million. And in terms of the age of the fund, you don't want to invest in anything that's less than 5 years old. Ideally, you want to focus on going for something that's 5 years old and above, in order to be able to assess the performance of that fund and just gain some confidence that this fund has been around for some time and it's worth your while investing in. Okay, so the second thing you want to check before you invest in your index fund or ETF is what's known as the tracking error. This is something that not many people talk about. It's something that's very, very important, the right type of index fund or ETF. Now, the tracking error is the degree to which the actual returns from the index fund or ETF that you are trying to invest to differs to the performance, i.e. the returns from the actual index that it's trying to track. Okay, so this is an example of a particular fund that I found as an example on the Vanguard website. I'll put this up on the screen for you guys to see the full picture. I've just written this out just to give an illustration of what we mean here. For example, these are the years that this fund has been going on for. It goes on for a lot longer than that. I've just written a sample just to show you what I mean. Here's the total return, which is the capital returns, i.e. the fund going up in value over time or down in value, plus the returns coming from the income in that fund, whether it's through dividends, for example. The total return is essentially the return you're getting in total from that particular index fund or ETF. And here's the benchmark that it's tracking. Now notice, a really good way to check, and the key thing you want to be checking is that the tracking error should be less than 2%. But a visual way of spotting this is to go and look at the performance section of a particular index fund or ETF, and then compare these two. You want to look at these two and make sure that they do not look very different to each other, i.e. that you don't have huge variations in how those numbers look. So you want to be able to say, here are my returns coming from this particular ETF or this particular index fund. And also when I look at the index, i.e. the benchmark that it's actually tracking, I can see that the returns are not too different. If they're very close to each other, then that's a very good indication that the tracking error is low. And by the way, the tracking error comes about for many reasons. One of which is that if a fund, an ETF or an index fund, is actually quite expensive, i.e. there are lots of fees going through that particular ETF or index fund, what that does is that it forces that particular index fund or ETF to not track that index as closely as possible. And so the cheaper that index fund or ETF is, the better and more likely that the tracking error will be as low as possible, which is what you and I want in order to choose a particular index fund or ETF. Oh, and by the way, if you want to know more about where to find information on the tracking error for a particular index fund or ETF, check out either in the key investor information document or look at the prospectus for that particular fund. They should definitely, at some point within those documents, give you some information around to what extent the particular index fund or ETF is tracking the particular index or benchmark that it's based on. Okay, so the third thing to look at are your fees. We talk about here the total expense ratio, or your TER, or some we refer to them as your ongoing charges as well. Now, I wanted to just look at this, but look at this by looking at the different market segments. So typically, we would say, try and invest in a fund that has really low fees. But what I find really interesting is to try and look at them by these various market segments, depending on what type of fund you are trying to invest in. So if you're looking at, say, a developed equity fund, which is typically a globally focused fund, the sort of fees you should be looking to pay at the very most should be at around 0.4% as a maximum. So you want something around that number or much lower than that. If the fund you're looking at is a UK equity fund, you want to be looking at around 0.2% or lower. Okay, so each of these numbers, you want it at around that percentage or a bit lower than that for it to be a reasonable fund to invest your money in. And then for fixed income, which are your bonds and so on, you want around, say, 0.25%. And then for these two, you're looking to pay at the most 75 basis points or 0.75% thereabouts. But remember, these are the maximum percentages that you want to be looking to pay depending on where that particular index fund or ETF is focused on from a market perspective. Okay, so the fourth thing to check for is the actual index being tracked. And what you want here is what's known as a total return index, okay? And a total return index is the type of index that not only tracks the capital growth of the index, of the constituent companies within that index, but it also tracks the income element. So what you have is the total return. So the returns coming from capital appreciation of the various constituent companies within that particular index, which is a list of companies, but you also get the income element. So you have in here capital plus income. This gives you your total return. Okay? Now this is important because it offers a much more accurate picture of the performance of that index. Okay, so the fifth thing to check is the replication method. So just to explain what this means. So if you think about what an index fund or ETF is trying to do, it's essentially a fund that's tracking a particular index. Now, when you think about the people who work behind the scenes to make all these things happen, they have to make a decision around how to go about performing that tracking. So one option they have is that they have full replication of the particular index. Imagine you've got the S&P 500 with 500 companies, the largest companies on the US equities market. An index fund is trying to track that particular index, which is the S&P 500. If there is full replication, which is what I'd highly recommend you check that the index fund or ETF is doing, It means that they are physically buying those particular stocks. So you really want to focus on this. You want an index fund or ETF that's essentially doing this type of work, where the focus is on full replication, as it were. Now, some managers take a different approach and focus on partial replication, which is not a terrible thing to do. And some go as far as actually exploring derivative instruments as a way of trying to do the same thing. Well, to be honest with you, the focus should be on trying to invest into an index fund or ETF based on the full replication method. Again, you can see these when you go and read the key investor information document, or if you go and look at the prospectus for that particular index fund or ETF. The full replication method essentially says to you that index fund, which is based on a particular benchmark or index, they actually own those units tied to that particular index. So if it's got, say, Apple shares on the index, they actually have a weighted share of Apple stock because they are tracking that particular index. Or if it's got, say, Amazon, they've got a weighting of Amazon shares physically replicated or purchased by the particular index fund or ETF. That is by far the safest option to focus on. Okay, so the next thing to check is the geographic exposure. Now, this matters because it helps to dictate what sort of returns you can expect by investing in that particular index fund or ETF. So here you're looking for things such as what proportion of my money is invested, say, in North America, for example, or what proportion is invested in Europe, for example. I'm going to put up on the screen a geographic exposure for a particular fund, which I've used as an example for today, which is the Vanguard FTSE Developed World ex-UK fund, which I believe the allocations here were about 70% thereabouts. The allocations here were about 14.9%, okay, and so on, and that carries on. But this is very important because it really then gives you an idea of how diversified that particular index fund or ETF is, and to what extent is that particular fund global, for example. So I love to explore funds that have a global exposure, because then it really then gives you the best possible chances of having your money really work as hard as possible for you in order for you to generate those returns that will help you achieve your goals a lot faster. Tied to also doing this, I look at sectors, okay? Again, I'll put something up on the screen so you can see what sort of things you want to be looking at with an example, that particular fund that I talked about earlier. You want to be looking at how much of your money is exposed to, say, tech sectors, how much of it is exposed to financial services, how much of it is exposed to, say, consumer services and so on. So all those elements are important because they really help you just better understand what levels of risk you're potentially facing and how you're able to reduce that risk by having your money potentially diversified in a globally focused fund, for example. Okay, so number 7 is to look at for minimums. So this is one of those things that fits those people who are looking to invest with a budget, for example. So certain investments might require you to have, say, £100 per month as a minimum. So you would need to be investing that sort of money in order to be able to invest in that particular index fund or ETF. Whereas some of them might not have a minimum. Some might just require that you have, say, paying a lump sum of maybe £500 to begin. Whereas other index funds or ETFs, depending on who is supplying those products, what broker you're buying them through, might not have any minimums at all. So, but looking at what minimums exist is very important, because if you're somebody, as I mentioned, who is conscious about not perhaps having to meet a particular amount of money each month, but just wants to invest, as and when, then you want to try and find a provider that has the products that fit your particular budget. Now, of course, the final one I want to mention today is to look at performance. This is typically what most people look at right from the very get-go. But I want to just mention it last because, past performance doesn't dictate future performance. But I love to look at performance because it just makes me feel good to know that the fund I'm trying to put my money into has been delivering for quite a few years. So I recommend looking over the last 10 years. Now, not all funds have been in existence for that long. And you might recall I mentioned earlier with the previous example that you want to look from an age perspective for a fund that's at least 5 years old. So if you can't find a fund that has a 10-year history, you want to look at one that has at least 5 years of history, because then you're really able to look at what the performance has been like over time and really just get a sense for what sort of performance you might expect, although, as I mentioned, past performance doesn't necessarily dictate what's going to happen in the near future. And the other thing to do when you look at performance as well is to look at the total returns, okay? I tend to prefer trackers that pay a dividend, because that helps to enhance the total return that you're getting. So that total return is then made up of the capital returns you're getting from that particular tracker, that index fund or ETF, really getting to work over time. And you might get a dividend also being paid by that particular index fund or ETF. I tend to prefer those. That gives me both returns to give me the best chance of being able to hit my ideal return goals. But the income return is not a necessity for you to invest in a particular index fund or ETF. It's a nice to have if you can get one in a particular type of fund. I have known funds that don't pay an income but still generate pretty high returns per year. Okay, that's it guys. I'm going to pop on the screen a summary of those 8 bits of checks that you should make before you invest into an index fund or ETF. These are by no means the only things that you should check, of course, because we all have varying requirements in our index funds and ETFs. But if you check for these 8 things, I can guarantee that it'll give you so much more confidence in knowing that you're investing in something that you fully understand, and you have the peace of mind knowing that you've actually done the checks before you've committed your hard-earned money towards making that investment. Guys, thank you so much for watching today's video. I've really enjoyed just explaining these various points you need to check before you make that investment into that index fund or an ETF. If you really enjoyed this video, the chances are you really enjoy our investing playlist, which I'll put in the links below and above for you to head over and check it out. The messages we get from people are that when they watch the playlist, they're literally binge watching. So please head over there and check out our investing playlist. I'd love to hear from you in the comments actually. What specific index funds or ETFs are you currently invested into? And did you actually check some of the things that we've mentioned on today's video before making those investments? It'd be really interesting to know. Just let us know in the comments what specific ones you are invested into. If you really enjoyed this video, don't forget to hit that subscribe button as well as that like button as a way of showing some love to us here at The Humble Penny. Thank you so much for watching today, and as ever, in all things, be thankful and seek joy. Take care guys, and bye for now. But the income return is not a necessity for you to invest in a particular index fund or ETF.